March 9th, 2023. It took exactly 10 hours to trigger the fastest bank collapse in United States history. No angry crowds outside the doors. No lines stretching around the block. No brick-and-mortar chaos. Instead, the entire disaster happened silently, through smartphone screens. In less than half a day, panicked tech billionaires and investors withdrew $42 billion from Silicon Valley Bank. $42 billion. Gone. At the speed of a single click. Silicon Valley Bank wasn't just any bank. It was the financial heartbeat of the tech world, holding the cash for major technology companies, venture capital firms, and thousands of startups. And yet, it was destroyed in less than 48 hours. This wasn't just a financial failure. It was the world's first digital bank run, fueled by WhatsApp groups and Twitter panic. No crowds, no broken windows, no people lining up outside bank branches. Just messages, posts, and a few taps on a smartphone screen. But how did a multi-billion-dollar titan vanish? Over a single weekend, the answer lies in a staggeringly stupid math mistake. To understand why the collapse of Silicon Valley Bank sent shockwaves through the world, you first have to understand who its clients were. Founded in 1983, over a poker game. SVB wasn't a bank for ordinary people. You didn't go there to open a basic checking account. You didn't go there for a car loan. No, SVB was the exclusive financial club for the tech elite. It was the place where venture capitalists, crypto founders, and some of Silicon Valley's most powerful billionaires kept their money. By 2021, if you were a tech startup in America, you didn't just choose SVB. You were practically forced to use them. During the tech boom of 2020 and 2021, Silicon Valley was drowning in free cash. Venture capitalists were throwing millions at almost any company, promising the next big thing. And almost all of that money ended up in one place: Silicon Valley Bank. In just 2 years, SVB's total deposits exploded. From $60 billion to a staggering $200 billion, the bank was drowning in money. But here lies the golden rule of banking. A bank cannot simply let cash sit in a vault. It has to invest that money to make a profit. And this is exactly where the executives of SVB made the most disastrous bet in financial history. When Silicon Valley Bank was flooded with nearly $200 billion in cash, during the tech boom, they faced a massive problem. They had too much money and nowhere to put it. To make a profit, the bank's executives made a choice that seemed completely safe. They invested over $90 billion of customer cash into long-term US government bonds. In the financial world, government bonds are considered one of the safest assets on earth. The government always pays its debts. But there was a catch. SVB locked this money into bonds that paid only a tiny interest rate, just 1.5%. And those bonds would remain locked for the next 10, 20, even 30 years. It seemed like a safe bet, a boring bet, until the Federal Reserve did something nobody expected. To fight inflation, the Federal Reserve began aggressively raising interest rates at the fastest pace in decades. Suddenly, new government bonds were paying 5% interest, not 1.5. And just like that, SVB's $90 billion bond portfolio became toxic. Nobody wanted to buy the old bonds anymore. Why would they? When brand new bonds offered much higher returns. On paper, SVB was sitting on a massive, hidden $15 billion loss. But there was one thing keeping the bank alive. As long as customers didn't ask for their money back, everything looked fine. The losses were real. They were just hidden. Then, in late 2022, the tech boom came to an end. Startups suddenly needed cash to survive, and they began withdrawing it. To meet those withdrawals, SVB was forced to do the unthinkable: sell the bonds. Early the moment they did, the hidden losses became real. What had once been a problem on paper instantly turned into a catastrophic $2 billion disaster. On Wednesday, March 8, 2023, Silicon Valley Bank tried to calm the markets. The bank admitted it had lost nearly $2 billion, but assured investors that it was raising new capital. It was supposed to be a routine announcement. Instead, it was like throwing a match into a gasoline factory, inside private messaging groups, and across social media. Some of the most powerful investors in the tech industry began to panic. Warnings spread rapidly. Messages were forwarded. Phone calls were made. The fear moved faster than anyone expected. And then the panic exploded across the internet. For the first time in human history, depositors didn't need to run to a bank branch. They didn't need to stand in line. They didn't need to leave their homes. They simply opened their phones. Thursday, March 9th, became the fastest bank run in modern civilization. Tech CEOs, while sitting at their desks, in meetings, or even at home, were frantically transferring millions out of SVB with a single tap. In just 10 hours, customers withdrew $42 billion. The bank's internal systems simply couldn't handle the digital stampede. By the end of the day, SVB had a negative cash balance of nearly $1 billion. They were completely broke. On Friday morning, before the stock market could even open, federal regulators rushed into the headquarters, locked the doors, and officially shut down the 16th largest bank in America. The 40-hour panic was over. But the economic nightmare was just beginning.
The collapse of Silicon Valley Bank triggered immediate panic across Washington. Officials quickly realized that if the government didn't act, thousands of tech companies could fail by Monday morning. Not because they were unprofitable, not because they were bankrupt, but because they wouldn't have access to their own money. Many wouldn't be able to pay their employees. Over that weekend, Washington went into crisis mode. Emergency meetings were held. Phone calls never stopped. Officials searched for a solution. Then, in a historic move, the Federal Reserve and the U.S. Treasury stepped in. They made a shocking announcement. Every single dollar deposited at Silicon Valley Bank would be fully guaranteed. Not just small accounts, not just ordinary depositors. Every dollar, even the millions belonging to venture capital firms, tech founders, and Silicon Valley's wealthiest investors. Long pause. The panic stopped, the financial system stabilized, and in a matter of days, the elite of Silicon Valley had been rescued. The same people who championed free markets, the same people who argued against government intervention, were saved by government intervention. The system proved once again that when the tech elite gamble and win, they keep the billions. But when they make a catastrophic mistake, the rules suddenly change, and the system moves to protect them. Silicon Valley Bank showed the world that in the digital age, a multi-billion-dollar empire is only as strong as its client's next tweet. The bank is gone, but the underlying flaw in the global financial system remains. In a world where money moves at the speed of light, the question is no longer if another bank will collapse. The question is, which one is next? Let me know your thoughts in the comments below. And if you want to uncover more dark business truths, subscribe and join me in the next investigation.